Welcome to Countarts. In this lesson, we're going to be looking at accounting for beginners. We're going to go through various parts in explaining exactly how accounting works and what you need to know. So if it's your first time doing accounting, or you're in your first year of accounting, or you're struggling with accounting as you have gone along, these lessons will help you understand the foundation of accounting, which will simplify the rest of the work that you will be doing. So I hope you'll follow along and you look at all the parts that we'll be going through. This is part 1, as you've seen from the description below, and we have the other parts in the links in the description below. So what is accounting? Well, accounting may be defined as the recording of financial transactions in money terms, reporting the results of such transactions, and drawing up financial statements for decision making. So if you know the accounting cycle, at the end of the day, we want to have the financial statement that we will use to make decisions. Your accounting journey is made simple by ensuring that you understand some key accounting terms, principles, and rules. We show you what you need to know to simplify your work. So instead of you reading pages and pages of a book trying to grasp how accounting works, we have simplified it in this series of lessons, and you will be able to pick up what you need to know as you're dealing with any topic when it comes to accounting, whether you're looking at journals, whether you're looking at the accounting equation, whether you're looking at ledgers, whether you're looking at the trial balance or the financial statements. This is a great foundation. So let's get into it. Part 1 deals with the accounting equation. Now, we have done it before in other lessons, but here we dive in deep in the accounting equation. Now, you may hear the word accounting equation and you may be like, I don't need to know that. But I can tell you this, if you can understand and master your accounting equation, it will greatly simplify the rest of your work when you're dealing with accounting, even to the point when you get to the financial statements. The statement of financial position is exactly the accounting equation. So if you can understand the accounting equation, it will help you understand anything that you are doing when dealing with accounting. So let's get into it. Part 1, the accounting equation. What is the accounting equation? Well, the accounting equation is assets equals equity plus liabilities. And that's a simple formula. And I'm sure when you think of accounting equation, you already know what the equation is. But do you know how to apply the equation well? Or are you able to look at an account and say that is an asset, that is equity, and that is a liability? Or are you able to define what an asset is? Are you able to know what equity is and what is liability? That's very important when it comes to understanding the accounting equation. So when you're looking at assets, equity, and liabilities, you should be able to know what accounts form part of each of these. But firstly, what is an asset? Well, I remember when I was in first year and we had to memorize the definition of an asset, but I'm not going to give you a technical definition that's not going to help you. And I remember the definition very well even to this day. An asset is a resource controlled by the entity as a result of past events by which future economic benefits are expected to flow to the entity. And we went through the breakdown of that definition. But here we're going to explain it very simply. What is an asset? Well, an asset is what you own or what the entity or the company owns. And we'll go through examples in showing you what forms part of an asset so that when you're looking at transaction, you will be easily able to pick it up and say this is an asset. It's very important understanding what assets are, what equities and what liabilities are, because even to the point when you're doing financial statements, you will need to know this very well. Now, assets, like we said, is what the company owns, and we'll go through examples just now. What about equity? Well, equity is your claim of the business or the interest of the owners in the business. So whatever the owners have invested in the business, that is their claim in the business, and that is their interest in the business. And we'll also look at examples of equity just now. And then liabilities. What are liabilities? Well, liabilities is what you owe. So if you owe someone something, that is a liability. Whether you've bought goods on credit and you have not paid them yet, that forms part of a liability. And the money that you owe them is a liability, or you've taken out a loan. Anything that you owe someone else as a company, just know that that is a liability. So pay careful attention what I have highlighted in red, and you will be able to know this. Assets is what the company owns. Equity is the claim of the business or the interest of the owners in the business. And liabilities is what you owe as a business. Now let's go through some examples. Let's begin with assets. What are some examples of an asset? Well, the first one we have here is vehicles. So whenever you have a transaction and you see a vehicle there, whether you are buying a vehicle or you are selling a vehicle, just know that the vehicle is an account that is an asset. Equipment. An example for equipment here is computers. These are also assets. So I'm sure you get the idea of what we're dealing with when you're looking at assets. Another one is furniture. Whenever you're dealing with furniture, you should know that that is an asset. And remember, everything that we mentioned under assets, under equity and liabilities will always be under those elements. They will never change. So when we're looking at vehicles, for instance, they will never end up being equity or liabilities. They will always be assets. Machinery is also an asset. So if you see machinery, just know that that one is an asset as well. Land and building, bank or cash. So bank and cash may be used interchangeably, or they may use both words. Bank meaning money in the bank, and cash meaning the cash that the company has on hand. But they are assets as well. Debtors control or trade receivables. These are also assets, and it's very important that you understand this because students usually make a mistake with debtors control and creditors control. But firstly, let's deal with debtors control. What is debtors control or trade receivables? Well, these are people who owe money to the business because we sold to them on account or on credit and they have not paid us yet. So it's very important. Debtors control or trade receivables are assets because it's what is owed to us. And why is it an asset if we don't have the money? Well, because we are due to receive the money. The money belongs to us even though we have not received it yet. They form part of assets. Now, this may be written as debtors control, trade receivables, or accounts receivables or receivables. So those terms may be used interchangeably. So just pay attention to that. And when you see the word receivables, that's easy for you to know it's an asset because of the word receive. We are yet to receive the money. It belongs to us as a company. So just remember that this is an asset. Inventory or stock or merchandise, these are also assets. And what is this? Well, these are items or goods that we sell in our ordinary course of business. So if we as a business are selling chairs, that will form part of inventory or stock or merchandise. If we as a business are selling cars, that will form part of our inventory or stock or merchandise. Now remember, these terms may also be used interchangeably. You might see the word trading inventory or trading stock or merchandise or goods. Those terms may be used interchangeably, but just know that they are always assets, right? What is owned by the entity. And these are some examples of assets. So I hope you will be able to pick it up when you are looking at a transaction that this is an asset or it's not an asset because it doesn't form part of an asset. Now there are other assets as well, such as intangible assets or assets that you cannot touch, you cannot see with your eyes, but we're not going to deal with that now in accounting for beginners because you're probably not going to deal with that yet. But another one that is an asset that you have not mentioned here is like fixed deposit. If you've invested money in a fixed deposit, that is also an asset. So just know that this list is not exhaustive. This is not everything, but these are the very common ones you will usually be dealing with. What about equity? What are some examples of equity? Well, equity is quite easier. We have a shorter list for this one. Here, the first one we have here is capital or shareholders' equity. What is capital? Well, capital is the contribution of the owners into the business. Whatever they have contributed into the business or whatever they've invested in the business, that is their capital or shareholders' equity. Now, it's called capital when you're dealing with a sole trader or sole proprietor, an entity that is owned by one person or a partnership or a close corporation. But when you're dealing with publicly traded companies, it's called shareholders' equity. So if you invest in the shares of the company, it will form part of shareholders' equity. So when you look at these words, capital or shareholders' equity, just know that they form part of equity and they will always be equity. Another one here is drawings. When you see the word drawings, that is also an equity account. What is drawings? Well, drawings is whatever the owners of the business have taken from the business for their own personal use. They could have taken money from the business, and they will tell in the scenario that the owner took 5,000 Rand for their own personal use or to use for their own personal needs. Then you will know that that is drawings, and drawings is an equity account, and it's a negative equity account because it reduces the equity of the business. Because if the owner has taken money from the business, it will reduce the equity of the business, right? And remember that drawings is not just when the owner has taken money for their own personal use. They could have taken an asset, they could have taken a vehicle for their own personal use. Then you also have drawings as an account there. I hope it has made sense. And the key word there is personal use. If they tell you the owner has taken money for their own personal needs or personal use, or to use it in their house, or to give it to a family member, then you know that that's for personal use, and that is drawings. Another one we have here under equity is income. Whenever you have an income or a company has made an income, that forms part of an equity and increases the equity of the business. Another one we have here is expenses. So whenever you're dealing with expenses, just know that that forms part of equity. And why is expenses part of equity? Well, because it reduces the equity of the business. For every expense that you have, the equity of the business is reduced. Just like income. For every income that you have, the equity of the business is increased. Then expenses is a negative. It reduces the equity of the business. So you have two things here under equity that reduces the equity of the business. It's drawings and expenses. And these are some examples of equity. And remember, this list is not exhaustive. It depends on the type of entity. For instance, if you're dealing with a company, you have other items of equity as well, such as preference shares, such as retained earnings or revaluation reserves. But the reason we didn't put that here is because we are doing accounting for beginners here. You're not going to deal with that right away. And then the next one we're going to look at is liabilities. What are some examples of liabilities? Well, here they are. The first one we have here is loans. And remember, liabilities is what you owe. So obviously, if you've taken out a loan, you owe the money to whoever borrowed you that money. The next one we have here is trade payables or creditors control. Now remember what I mentioned when we're dealing with assets and we're giving the examples, and I said under assets we have debtors control or trade receivables, and sometimes students confuse that one. Well, they confuse creditors control and debtors control, or trade receivables and trade payables. They are not able to tell whether it's an asset or liability, but I hope from this one here you won't confuse it again. When you're looking at creditors control, these are the people that you owe money to, usually that you've bought goods from them on account or on credit and you have not paid them yet. You'd record them under creditors control or trade payables. Again, these terms may be used interchangeably. It may be written as trade payables or accounts payables or creditors control. So just remember that that is a liability. So you should be able to look at that, either creditors control and debtors control, and know instantly that this is a liability or this is an asset. The next one that we have here is bank overdraft. What is bank overdraft? Well, bank overdraft is when our bank balance is in a negative. Whenever it's in a negative, then we are at a bank overdraft. So remember, under assets, when you see the word bank, you know that's an asset. But when you see the word bank overdraft, just know that that is a liability because we owe that money to the bank. Remember, we've used more money than we had in our bank account, and now we owe the bank that money. So when you see bank overdraft, just know that that is a liability. So I hope you remember these terms, and you will see how they will simplify your work just now as we'll be going through the examples of the accounting equation. So take a snapshot of this page or take a picture of this page, or remember these terms that we have been looking at under assets, under equity, and under liabilities. These are accounts that you'll usually be dealing with even when you're doing your journals. So let's get into the example of doing the accounting equation. This is recording transactions in the accounting equation. So let's bring up our accounting equation once again. It's assets equals equity plus liabilities. But one thing you must always remember is that for every transaction, there are at least two accounts. That's very important. For every transaction, there are at least two accounts. Now, there may be more than two, but most of what we'll be dealing with, especially in your beginning stages of accounting, will be two accounts. You'll never have a transaction with only one account. There are at least two accounts. Now, it could be any of the accounts that we've been mentioning in the examples in the previous slides of assets, equity, or liability. So it could be two accounts that are assets, or one account that is an asset and another which is an equity, or one that is equity and liability. So it could be a combination of any of those. You should be able to identify what accounts are affected in each transaction. Once you can do that, that has made your work quite easy. And that is why we went through that exercise of knowing what are some examples of assets, what are some examples of equity, and what are some examples of liabilities. Now, let's go through the examples and showing you how to identify accounts. Here's the first scenario that we have. The owner invested in the business by depositing 20,000 Rand. So what is happening here? The owner is investing in the business and is depositing 20,000 Rand cash. So he's depositing money into the business. That is his contribution to the business. Now, what are the two accounts involved in this transaction? Think about them and think through what we've mentioned in the previous slide when we went through the examples. Well, the first one here you can pick up very easily is bank or cash. Because the owner is bringing money into the business, the first account we have here is bank. Alright, so it's bank or cash, but we'll use the word bank. And then what is the second account? Now, whenever you see the word cash or the word check, you know that is bank. Alright, that is bank or cash. So always know that is the easiest account that you can pick up. The second question that you ask yourself is, why is that money coming into the business? What is it for? Well, the owner is investing in the business. So what account is that? Well, if you remember and you heard carefully, it is capital. Because the owner is investing in the business, the next account is capital. So what are the two accounts? The first account is bank and the second account is capital. So how do we do this in the accounting equation? Well, we ask ourselves, what is bank? Is it an asset? Is it equity or liabilities? Well, I'm sure you can remember, bank is an asset. So we're going to put the 20,000 Rand under the assets section and we call it bank, that is the account that is involved. And why do we put the plus sign? Well, because it's increasing the assets of the business. So whenever it's increasing the assets of the business, we put it as a plus. Whenever it's going to be decreasing any of the three elements, then we'll put it as a minus. Now that we've identified the first account and the second one, which is capital, what is capital? Capital is equity. So we're going to put 20,000 Rand under equity and obviously we call it capital. Now, do you see why it was important for us to know what is an asset, what is equity and what is liabilities? Because it helps us identify it and apply it in our accounting equation. And you'll see even when we'll be looking at journal entries, you will see it's very important that we understand this as well. So you can see that our assets equals equity plus liabilities, because under assets we have 20,000 Rand, under equity and liabilities we have 20,000 Rand because we have nothing on liabilities section. For every transaction that you are doing in the accounting equation, just make sure that your assets still equal equity plus liabilities. Let's look at the second example here. Bought inventory on credit, 3,000 Rand. What are the two accounts involved here? Well, the first one that you can easily pick up is inventory. Alright, they could have said bought goods or bought merchandise or bought stock. Remember, I said those terms can be used interchangeably. So the first one that we can easily pick up here is inventory, because we are buying inventory. And the second question, which is a tip that can help you identify the second one, is if we are buying something, ask yourself, how did we buy it? Did we pay for it in cash? If we did, then the second account is bank. But if we did not, like here we're told we bought it on credit, that means the second account is trade payables or creditors control. Remember, again, I said those terms can be used interchangeably. So we're going to use trade payables. So we've identified the two accounts. One is inventory and the second one is trade payables, because we're buying the inventory on credit. Now, what do we say? What is inventory? Is it an asset, equity, or liabilities? Well, it is an asset if you remember correctly. So we put the 3,000 Rand under assets, and obviously the description is inventory, or the account is inventory, and we put it as a plus because it's increasing the assets of the business, because inventory is coming into the business. And the second account, as we identified it, is trade payables, and that is a liability if you remember, because we have to pay it. Payables, we have to pay it to the supplier at some point, and the amount is 3,000 Rand, and it's increasing the liabilities or the amount of money we owe other people. Now, I hope you can see how the application works here. Again, does our asset equal equity plus liabilities? Yes, it does, because we have 3,000 Rand on the asset side for this transaction, and under equity there is nothing, and under liabilities we have 3,000 Rand. So you can see our assets still equal equity plus liabilities. The third one that we're going to look at here is paid the telephone account by check, 700 Rand. Now, what are the two accounts involved here? Well, now this is where you have an expense account. What expense are we paying for? We're paying for telephone. So telephone is an account that is an expense. And then how did we pay for it? That is another question that you ask yourself. When you're paying for an expense, ask yourself, how did I pay for it? Did I pay for it in cash, or do I still owe that money? Well, we paid by check. So remember I said they can say you paid by cash or by check. That is the same thing. It means we paid cash. So bank is affected there. So we have identified the two accounts. The first one is telephone and the second one is bank. Now, what is happening to our bank account? Is it increasing or decreasing? Well, it's decreasing, so it's going to be a minus. And what is bank? Is it asset, equity, or liabilities? Well, I hope you know now. It's an asset, so we'll put minus 700 Rand under assets, and which is a bank account which is reducing. That's why we're putting it as a minus. And under equity, we put minus 700, and the account there is telephone. So remember I said under equity we've got capital, drawings, income, and expenses. Well, telephone is an expense, so we don't just put the word expense there, we put the name of that particular expense, and in this case it's telephone. And telephone reduces the equity of the business because it's an expense. Alright, and you can see our assets still equals equity plus liabilities because we have minus 700 Rand on the asset side and minus 700 Rand on the equity side. So assets equals equity plus liabilities. Let's look at the fourth example. Bought inventory by check, 1,500 Rand. Again, what accounts are involved here? Well, the first one is easy to pick up. It's inventory. And the question you ask yourself there is, how did we buy it? Did we buy it on cash or did we buy it on credit? Well, here you can see the word by check. That means we bought it on cash. So the next account is bank. So we've identified the two accounts. The first one is inventory and the second one is bank. Now, what account is inventory? Well, inventory is an asset. And what account is bank? Well, bank is also an asset. So what do you see here? We have two accounts that are both assets. So what is happening here, or how do we record it in the accounting equation? Well, here is how it will look. We have plus 1,500 Rand for inventory because inventory is coming into our business, but we have minus 1,500 Rand for bank because money is leaving our business, so it's leaving our bank account because we're paying for that inventory. And you can see our assets still equals equity plus liabilities because under assets we have plus 1,500 minus 1,500, which makes it 0, and under equity there is 0, and under liabilities there is 0 for this particular transaction. Alright, let's look at number 5. Paid the supplier 3,000 Rand in settlement of account. So we paid a supplier 3,000 Rand in settlement of account, meaning we're settling the account that we owed the supplier. So what are the two accounts involved here? Well, since you see the word paid, you know that bank is involved, so that's the first account. And the second one that is involved here is trade payables. Remember, we are settling the supplier's account. So we're going to have minus 3,000 Rand under bank, which is an asset, and minus 3,000 Rand under liabilities for trade payables because we are clearing the trade payables, or the amount that we owed others is reducing because we're paying them. And you can see our assets still equal equity plus liabilities. Let's look at number 6. Bought stationery by check, 150 Rand. Now, what are the two accounts here? Well, you see the word check here, so you know that bank is involved. That's an easy one. And what is the second account? What were we paying for? What were we buying? Well, we're buying stationery. And what is stationery? Stationery is an expense account, if you did not know that. Stationery is an expense. That means it goes under equity. So it's going to be minus 150 Rand under bank and minus 150 Rand under stationery, which is an equity account. So here's how it's going to look. So whenever you're paying for an expense, or you've just paid for an expense, you can see that you'll have a minus for bank under assets and minus for that expense under equity, and this expense is called stationery. Let's look at the next one. Number 7 says the owner drew a business check of 2,000 Rand for his personal use. What are the two accounts involved here? Well, you can see here the owner drew a business check. So a check is involved here. That means bank is involved. So it's going to be a negative for the bank because money is coming out of the business because the owner drew this check. And why was he drawing this check? What was it for? Well, it says for his personal use. Well, if you remember correctly what I mentioned, that if it says the word personal use, that means we have drawings, and drawings is an equity account. So here's how it's going to look. Minus 2,000 Rand under assets for bank and minus 2,000 Rand under equity for drawings because it's reducing the equity of the business because the owner took something from the business, and in this case, it took money from the business. All right, let's look at the next one. The tenant paid the monthly rental to the company 2,500 Rand. Now, it's also very important to be able to know whether it's rent income or rent expense. Well, in this case, it's rent income because the tenant paid the monthly rental to the company. If it's the company that was paying, it was going to be a rental expense. But if it's a tenant that is paying us as the company, then that's rent income. So what is the two accounts involved? Well, I've already mentioned the first one, rent income, and rent income is an income account, and income is recorded under equity. And what is the second account? The second account is bank. Bank is an asset, obviously, and we'll put it as a positive, because if someone was paying us, in this case a tenant, it's increasing our bank account. So it's going to be plus 2,500 rand for bank under assets, and plus 2,500 rand for rent income under equity. And remember, like I said, income increases the equity of the business. Let's look at one more. Number 9 says the owner contributed a vehicle worth 30,000 rand to the business. Well, if the owner is contributing something to the business, that is capital. Remember, when the owner is contributing something to the business, it doesn't have to be money only. It can be something else, like an asset, and in this case, it's a vehicle. So what are the two accounts involved? I hope you can think on your own and identify what they are. The first one you can see here is quite easy, is vehicle, because the owner is bringing a vehicle into the business. And the second one that we have here is capital. Whenever the owner is investing in the business, either cash or an asset, just know that the account there is capital as well. So we have vehicle and capital. Vehicle is an asset account, if you remember from the examples that we gave, and capital is obviously an equity account. So we have plus 30,000 rand for vehicle, because vehicle is coming into the business, and plus 30,000 rand for capital, because it's increasing the equity of the business. And that is how you apply the theory we've been going through in the accounting equation, and in understanding how the accounting equation works. Now, always make sure that after each transaction, your assets still equals equity plus liabilities. Now, if I sum up my asset section, my equity section, my liability section, I should be able to see that my assets still equal equity plus liabilities. As you can see, with each transaction or with each line item, our assets did equal equity plus liability. So always make sure that is the case, and that is how you can gauge whether you've gotten it correctly. Alright, this was the first part that we went through in doing accounting for beginners. So you'll find the link to the next lesson, which is part 2 for accounting for beginners. So we'll go through the journal entries where we have debits and credits. See you in the next one.